Hello, welcome to Hotel Hero. The name of this video is How Futures Derivative Contracts Are Used to Manipulate Markets. Let's begin. There's a lot to cover. So right here I got what's called an ICE contract. It's an International Commodities Exchange contract. And for $3,000, I can buy one contract which controls 40,000 pounds of coffee. We're using coffee. It's the second most traded commodity in the world. Investor 1 buys a contract for 40,000. Investor 2, which is me, buys one for 40,000, and then there's a coffee producer that buys a contract for 40,000, trying to lock in his prices, and hopefully maybe prices go up, they can make even more profit. But because we're controlling 40,000 pounds, if the price of coffee goes up $1, we make 40 grand. If it goes down $1, we lose 40 grand. It's not for the faint of heart. So obviously you would put in a stop loss. So each one of us say, you know what, we're willing to lose 10 grand. So we'll put our stop loss at 25 cents. And if it drops by 25 cents, we lose our 10 grand, lick our wounds, and trade another day. Well, what if some entity like JP Morgan, my least favorite bank on the planet, decides, oh, we want to be in the coffee business. So they run out and buy 100,000 contracts. And by the way, they don't have to pay as much as a margin because they're a big time dealer. So we have to pay $3,000 for the margin. They only have to pay $2,000. And so they have to come up with $200 million as the margin, which is no big deal for JP Morgan. They have trillions in assets and they can always borrow money from the Fed if they need it. So by buying these 100,000 contracts, on paper, JP Morgan would actually control 4 billion pounds of coffee, or 8% of the total annual global supply. That's the leveraging power, and that's how powerful it is. So what happens if JP Morgan out of the blue on a Tuesday at 3 o'clock in the morning decides, I don't want these coffee beans, and they turn around and they drop 100,000 contracts of coffee onto the market when there's literally no buyers? And by the way, they're not even put a limit there. They don't care. They just want to manipulate the price because they might have a side bet somewhere. Well, what happens? You just added 4 billion pounds of coffee in the market. The price is going to drop. So when the price drops below the 25 cents, it triggers our stop losses, and we're out. JP Morgan collects the profits because that's what happens. So easy money for them. And they've been doing this for decades. In the gold and silver industry, it's called wash, rinse, and repeat. And it's estimated, at least with gold and silver, that miners and retail investors lost over $1 trillion to the banks and the hedge funds because of the futures contracts. Anyways, I hope you found this helpful, and God bless you today.